Imagine waking up one morning in 2026 to a world that looks familiar. At first glance, but isn't. The news anchors speak in calm tones, but their eyes give away something else. Markets are falling. Banks are tightening. Congress is arguing behind closed doors. Treasury officials aren't sleeping. And somewhere in Washington, a quiet truth is being whispered. We've lost control of the credit system. Not because of a war, not because of a disaster, but because something small and silent broke, something hidden so deep inside the machinery of modern finance that most people never even knew it existed. For decades, the United States has been the anchor of the global economy, the issuer of the world's reserve currency, the creator of credit, the stabilizer of markets, the buyer of last resort. But in 2026, the anchor slips. The chain snaps, and a domino falls slowly at first, then violently setting off the largest credit collapse in modern history. This is not a fantasy. This is not a conspiracy. This is not a prediction meant to scare you. This is the result of decisions made decades ago, decisions that changed the very nature of money, credit, debt, and power. Decisions that built a financial machine so large, so complicated, and so dependent on constant growth that one day, inevitably, it would reach a limit. The 2026 U.S. credit collapse is not a surprise to those who understand how the system works. In fact, it is the system working exactly the way it was designed to, just pushed too far for too long, until the underlying math finally refuses to bend any further. To understand why 2026 is the breaking point, we need to travel backward. Not to 2008, not to the dot-com era, not even to the 1980s. We have to go to a moment that didn't feel like a crisis at the time, but quietly changed everything. August 15th, 1971, the day the United States ended the convertibility of the dollar into gold. The day money became an idea instead of a promise. The day debt became the engine of the entire economic system. Most people know the headline, the end of the gold standard. But few understand what it truly meant. Before 1971, money represented something. After 1971, money represented someone's debt. Every dollar became a liability created by a bank or issued by the government. Every loan created new money. Every credit expansion became an expansion of the money supply. Debt was no longer a burden. It became a product, tool, a source of profit. Banks discovered that they could lend more than they had. Corporations discovered they could finance growth with borrowed money instead of earned money. Governments discovered they could spend endlessly without raising taxes. Consumers discovered they could live beyond their means with credit cards, mortgages, and auto loans. A new kind of economy was born. It's not one built on productivity, not one built on savings, but one built on ever-expanding credit that had to grow faster than the real economy in order to keep the system from collapsing. This was the quiet beginning of the machine that would one day break. In the 1980s, deregulation accelerated everything. Banks gained power. Wall Street engineered new financial products. Corporate America learned that debt wasn't dangerous. It was profitable. Consumers were encouraged to borrow. The government ran deficits without hesitation. In the 1990s, a booming market masked the dangers. The system grew larger. Credit expanded into every corner of life. Money flowed freely. And the world bought into the idea that America's financial system was invincible. By the early 2000s, the credit system was no longer a tool. It was the foundation of everything. Every crisis that followed only made it stronger. The 2000 dot-com crash. More credit. The 2008 mortgage collapse. More credit. The pandemic. The largest credit expansion in world history. Every shock to the system was fixed with the same medicine. Lower interest rates, more borrowing, more liquidity. But no one asked the real question. What happens when the medicine stops working? The answer arrives in 2026 slowly, mathematically, inevitably. Because behind the scenes, three forces have been building for years, each one manageable on its own, but catastrophic together. First is simple. Debt has reached a level that can no longer be paid, only rolled over. But rolling it over requires low interest rates. Low interest rates require stability, trust, and inflation under control. None of these conditions exist anymore. The second force. Interest rates rise faster than the economy grows. This is the moment economists fear more than any other. When borrowing costs exceed economic output, the system begins consuming itself. Government budgets tilt upside down. Corporations suffocate. Households fall behind. The third force is the most dangerous and the least visible. Trust begins to erode. Not all at once, not dramatically, quietly, slowly, subtly. Foreign buyers start reducing their purchases of U.S. bonds. Domestic banks begin tightening credit. Corporate defaults rise. Consumers struggle to keep up with higher interest payments. Markets feel fragile. Headlines start turning pessimistic. And then in early 2026, something small breaks. It doesn't make front-page news. It doesn't cause instant panic. It doesn't even seem dramatic at first. A U.S. Treasury auction underperforms. Buyers demand higher yields. The government must pay more to borrow. The bond market wobbles. Then everything changes. Bond yields surge. Stock markets fall. Banks pull back. Credit dries up. Corporate debt, once cheap, suddenly becomes unpayable. Defaults rise. Accelerate. Consumers cut spending. GDP shrinks. Government revenues fall. The deficit widens even more. The machine begins to seize. What happens next feels like a slow-motion car crash. Mortgage rates spike. Housing markets freeze. Families who bought homes at low rates find themselves trapped. Small businesses lose access to credit lines. Corporations relying on cheap loans suddenly face refinancing at triple the cost. Pension funds panic as bond prices crash. State governments face the reality that their liabilities are unpayable. Banks begin losing trust in each other. Interbank lending tightens. The plumbing of the financial system, the invisible network that moves trillions every day, starts to clog. Global markets respond instantly. European banks wobble. Asian markets fall. Emerging market currencies sink. Countries with dollar-denominated debt scramble for liquidity. Ironically, the US dollar goes up not from strength, but from panic, because in times of crisis, everyone rushes into the currency of the country that caused the problem. The Federal Reserve steps in, but its tools no longer have the power they once did. Rate cuts don't stimulate lending because banks are terrified. Quantitative easing doesn't calm markets because investors interpret it as desperation. Government stimulus only worsens the deficit. Every fix is a failure. It's not because the policymakers are incompetent, but because the system itself has reached its mathematical limits. You cannot solve a debt crisis with more debt. You cannot restore trust by printing money. You cannot fix a credit collapse by expanding credit. The breaking point has already been reached. By mid-2026, the United States enters a full credit freeze. It's not a total collapse of civilization, not a dystopian breakdown, but something subtler, and in many ways more dangerous. Suffocation of economic activity, a paralysis of financial movement, a grinding, slow erosion of the system's ability to function. Jobs disappear. Savings evaporate. Credit becomes scarce. Markets stagnate. Governments become desperate. Corporations shrink. Households tighten everything. The world does not end, but an era does. And as we study the fallout, a familiar pattern emerges: one seen in Rome's decline, in France's hyperinflation, in the collapse of the Ottoman Empire, in the fall of the Soviet Union, in Japan's lost decades, in the crisis of 1929, in the crisis of 2008. Every major financial system in history eventually reaches the same point. The moment when debt grows faster than the economy. It's the moment when interest payments exceed the budget. The moment when trust can no longer be sustained. The moment when collapse is not a possibility, but a timeline. And the timeline ends in 2026. After the crash, the world enters a new phase, not of destruction, but of reorganization. Countries redesign their financial systems. Digital currencies emerge as tools for control, not convenience. Inflation becomes a permanent feature, not a temporary problem. Real assets, land, metals, energy retain value. Financial asset stocks, bonds, futures become volatile, unpredictable, fragile. The United States remains powerful, but no longer unquestioned. The global order shifts, alliances change, trade routes evolve, new economic blocks rise, old ones fade. The world reluctantly accepts that the age of cheap credit is gone forever, and in the aftermath, 3 lessons stand out. First, debt is not dangerous. It is the design of the debt system that determines its fate. A system requiring infinite growth cannot survive in a world with finite trust. Second, financial collapse is not the end. It is a reset, a clearing of the slate that allows a new system to emerge. Every empire goes through it. Every currency goes through it. Every generation faces it in one form or another. Third, those who understand the mechanics of money, who study history, cycles, patterns, are the ones who adapt and thrive in the aftermath. Everyone else wakes up one day and feels like the world changed overnight. But the truth is simple. The collapse doesn't happen overnight. It unfolds slowly, and then suddenly. And the early stages of the 2026 collapse are already here. Visible in the bond market, visible in corporate debt, visible in government spending, visible in the interest burden, it's visible in household data, it's visible in foreign demand for U.S. treasuries, visible in the tightening of global credit conditions. The reset isn't coming. It has begun. If you want to understand the real forces shaping the world, if you want to see past headlines and into the hidden architecture of money, and if you want to prepare, not panic, then stay curious, stay informed, and stay aware of the patterns that history repeats. Because the story of the 2026 credit collapse is not the story of an ending. It's the opening chapter of a new financial era, one whose rules haven't been written yet, and whose consequences will define the next generation. If you want more deep explorations into the hidden mechanics of global finance, if you want to understand the real system behind the headlines, and if you want to prepare and not react, then subscribe, share this video, and stay tuned, because the story of money isn't ending. It's entering its most dramatic chapter yet.